Good morning. We are opening today's session witnessing a clinical bifurcation within the Magnificent Seven. The homogeneous trade is officially dead, replaced by a brutal performance dispersion. On one side of the ledger, we have Meta Platforms, which has successfully navigated the monetization gap by demonstrating a clear link between its AI infrastructure spend and a 41% operating margin. On the other, Amazon has hit a reality wall. Despite 60% sequential growth in its Bedrock platform, the market is severely penalizing the company for a $200 billion capital expenditure plan that is projected to push its free cash flow into negative territory for the first time in years. While Meta's ad revenue cash fountain provides a buffer for its $135 billion pivot, Amazon's stock has descended into a bear market, gapping down 20% from its November highs. The scale of capital allocation we are tracking today is unprecedented. Aggregate capital expenditure for the Magnificent Seven is now projected to exceed $700 billion in 2026. To put that in perspective, this single-year spend surpasses the annual GDP of the United Arab Emirates or Israel. Amazon, AMZN, guiding for $200 billion, a massive surge from $131 billion last year. Alphabet, Google, midpoint guidance of $185 billion, supported by a planned $15 billion to $20 billion high-grade bond sale to maintain its positive cash flow posture. Microsoft, MSFT, currently on a $144 billion annual run rate, though institutional fatigue is setting in as CapEx now consumes nearly 95% of operating cash flow. Meta, earmarking up to $135 billion for Project Avocado and Project Mango, the next generation of superintelligence models. This transition from cash flow financing to debt-funded infrastructure is a critical risk factor we are monitoring. Looking toward 2030, we have moved beyond the experimentation phase into the industrialization of AI. The competitive moat is no longer just about model weights, it is about energy and vertical integration. Meta's procurement of 6.6 gigawatts of nuclear power through GE Vernova and Cameco is a definitive move to de-risk its Titan clusters from a constrained U.S. power grid. Meanwhile, Nvidia has provided the most transparent long-term roadmap in the sector. With Rubin launching this year, Rubin Ultra in 2027, and the Fineman architecture scheduled for 2028, Jensen Huang is positioning for a $4 trillion global AI factory build-out. We expect the focus to shift from training to agentic AI and physical automation, with over 2 million developers already building on Nvidia's robotic stack. The winners of the next 5 years will be those who control the energy moat and successfully transition from foundational research to industrial-scale inference. That is the clinical breakdown for this morning. For daily updates on institutional sentiment and the technical signals moving the Mag 7, hit the subscribe button for notifications.